So most people think cap rates is just a fancy way to say return. But here's a lesser known truth. Cap rate is a reflection of market psychology, not just math. It's how investors quietly measure fear, greed, and opportunity all in one number. And let me show you. Imagine two investors looking at the same 10-unit building earning 120,000 net operating income, NOI. So investor A values it at 2 million, which is a 6% cap. Investor B says it's worth 1.7 million, a 7% cap. They're not arguing over rent, they're arguing over risk. So let's unpack what cap rate really means. So the formula is simple. Cap rate equals NOI divided by market value. So NOI means your property's annual income, like after expenses like taxes, insurance, and maintenance, but before mortgage payments. So if your property makes $120,000 NOI and it's worth 2 million, your cap rate equals 6%. And that's the return on all cash the buyer would expect. But here's the twist. Cap rate doesn't measure financing, leverage, or future appreciation. It's purely an unleveraged snapshot of return versus value, a yardstick for comparing deals. So there's four factors that move cap rates. And so number one, is interest rates. So when the Federal Reserve raises rates, bar borrowing becomes expensive. Investors demand higher returns to justify that risk. And these are real estate investors. So cap rates rise and values fall. It's like bond yields. When rates go up, prices go down. And then, of course, the opposite happens when interest rates go down and the prices go up. So, for example, $120,000 net operating income at 6% equals $2 million value, and a $200,000 net operating income at 7% equals $1,714,285 value. And the income didn't change. The market tolerance for risk did. So that's number one. So number two is location. The stronger the market, the lower the perceived risk, and the lower the cap rate. So prime areas like Miami or Austin, Texas, they trade around a 4 to 5% cap rate. But a small town or rural market might demand an 8 or 9% cap rate. It's the same income, but wildly different prices. So example, 120,000 NOI at 4.5% equals 2,670,000 or $2.67 million. And a $200,000, 120,000 NOI at 8% equals a $1.5 million. So location, not math, created over $1 million in difference. So again, let's just make sure we are on the same page. And you might want to write this down. $120,000 NOI at a 4.5% is 2.67 million, and a 120,000 NOI at 8% equals 1.5 million. So you see that $1 million, over $1 million difference just based on where that property is located. All right, so number three, property type. Each asset class carries its own risk profile. So multifamily typically a cap rate of 4 to 6%, mainly because of steady tenants, steady income, typically associated with multifamily. However, industrial is 4 to 7% cap rate. Typically, those are longer leases and a moderate risk associated with industrial. Retail is 6 to 7%, and it depends on local economy. Depending on where that property is that retail property is located will really depend on how well those stores and so forth do. Hotels, 8 to 10% plus, high because of higher risk and volatile occupancy. Sometimes it's seasonality or when people stays in hotels or what's going on, right? So the same NOI, but investors price certainty, not just cash flow based on those property types. So number four is market conditions. So cap rates compress in boom times and expand in downturns. When optimism runs high, investors accept lower returns, betting on appreciation. So during recessions, fear raises the yield they demand. So think of it like a rubber band. Optimism tightens it, fear stretches it. So how do real estate investors use cap rates? So cap rates help investors compare deals quickly across markets, estimate property value using NOI, gauge how interest rates affect portfolio value, and signal when to buy or sell. So, for example, if multifamily cap rates in your market rise from 5% to 6.5%, your property value just dropped 23%. Whoa. Now, savvy investors spot this early. They refinance or exit before the lag hits the market. So the next time you see a property listing, don't just ask, what's the cash flow? Ask, what does this cap rate say about the risk and market confidence? Because the cap rate is like your property's credit score. It reveals more about its trustworthiness than its income statement ever could. In one of the videos, and definitely check in the comments below, talk about the rent, the gross rent multiplier, and another way to look at and evaluate a property. And definitely follow me for more breakdowns on real estate investing as well as funding so that you can move like a lender and not just a buyer.